Do this before it's too late. I'm your host, Steve Metre, and thanks for joining me today. Retail Tycoon issues chilling warning that you should prepare for the worst. Let's over to Business Insider, where we picked today's story up as Amazon founder Jeff Bezos warns a recession is looming and Americans should prepare for the worst. Jeff Bezos has warned a U.S. recession is looming and advised consumers and businesses to stockpile cash in case there's a devastating downturn. Now, I find this very interesting, his comments, because what have we been hearing from the Federal Reserve? That there's tons of cash, that Americans are loaded with cash, that they have months and months and a huge reserve of cash to spend. And yet here Jeff Bezos is saying, hey, you may not have enough. You need to raise cash. Let's take a look at what the Fed is referring to. And they're talking about this overnight reverse repo, which is really the Fed backstopping money markets because there's a collateral shortage to the tune of $2.165 trillion. But what the Fed perhaps is overlooking that Bezos is not is the personal savings rate is down to 3.1%. Now, if you're not familiar with what this is, I first want you to know that we don't see this level so low since actually just before the great financial crisis. And what this number means is the percentage of an employee's paycheck that's left over for investing. So when that number gets really small, it implies that savings are going down, not as the Fed thinks they're going up. And that perhaps is why Bezos is saying, hey, it's time to raise cash. The economy does not look great right now, he said. Things are slowing down. You're seeing layoffs in many sectors of the economy. The probabilities say if we're not in a recession right now, we're likely to be in one very soon. Now, let's put this into context because from the post-pandemic highs, when we had massive fiscal and monetary stimulus, the economy has slowed. So in a sense, it feels like a recession, but not in the sense of the traditional recessions we've seen during the great financial crisis or the dot-com bust. Now, if the economy continues to slow, there's no doubt we'll see more of what the recession we're used to seeing. But notably, he mentions layoffs are increasing just at a certain time when one big company announced massive layoffs. Amazon plans to cut 10,000 jobs in largest ever layoffs for the e-commerce giant. The layoffs, which could begin as soon as this week, will likely target Amazon devices groups responsible for Echo smart speakers and Alexa digital assistant, as well as Amazon's retail divisions and human resources, according to insiders. Now, what you're hearing here is this is interesting because just before this, we heard that Amazon was going to hire a bunch of people for the holidays, and yet now we're seeing layoffs. What's the confusion here? Well, there isn't much because they're talking about hiring a lot of part-time people, and what you're hearing about these layoffs, these are full-time jobs that are now going away. Chief Executive Officer Andy Jassy has vowed to streamline operations amid slowing sales growth. Now, key this, listen to what we're hearing from the CEO, slowing sales growth and economic uncertainty, the latter part more likely due to the Fed. Last month, the Seattle-based company predicted that the holiday sales period would be the slowest in its history, spooking Wall Street and taking the shares. Now, notably, we're seeing stocks rally here. So what we're seeing from the equity market is that perhaps it believes that the holiday season will be stronger than retailers believe. So the question is now, who is right? Is the market right, or are Amazon's data right? Well, soon enough we'll find out, but for the moment, stocks seem to be heading higher on the notion that there's some other things going on, which we'll get to later in the show. Some longtime Amazon employees, also speaking on condition of anonymity to discuss an internal matter, said the cost cutting in the last few months have been the most severe. So again, hear these words, cost cutting in the last few months has been the most severe they've ever experienced. And this should not come to a surprise because businesses right now want to overall hang on to employees. Now we're seeing some companies like Amazon cut some employees, but overall, when you have periods of high inflation where you're forced to give employees raises and now you're seeing business slow and you're not ready to part with all of your employees just yet, what do? Internal cost cutting. So when you're Amazon saying, look, we're cutting costs and it's really severe, it tells you things inside the big retail giant are far worse than we realize. Bezos recommended American households delay big ticket purchases such as new TVs, refrigerators, and cars, given the risk that economic conditions worsen. Similarly, he suggested small business owners consider holding off on investments in new equipment and build their cash reserves instead. So again, we hear Bezos saying, raise cash, stop spending. Now, what's interesting is you'd think that he would be trumpeting spending money because that means his company and his stock price would go up, and so too would his net worth. So do you think that Bezos is just being a nice guy and trying to look out for you? Or do you think perhaps maybe he's got some put options on Amazon stock, or he's got some other ways that he's going to swoop in when it's cheap? What do you think? Let's continue on. The e-commerce pioneer declined to estimate how long the recession could last, but he urged people to be ready for an economic disaster. Take as much risk off the table as you can, hope for the best, but prepare for the worst. Bezos' latest comments echo his response to Goldman Sachs CEO when he said there's a good chance of a U.S. recession. Yep, the possibilities in this economy tell you to batten down the hatches, Bezos tweeted. Now, notably, again, all these warnings, and what he's suggesting here is, look, raise cash, because if this isn't a recession or it's very mild, well, then you've got cash you can deploy it into the economy. If it's worse than we think, then you've got cash to get through it. Good advice, but do you think his timing is right or wrong? Because what could Bezos be looking at to give him the indication? Could it just be Amazon's internal sales data, or could he also be looking at the shipping industry? As FedEx parks planes as weak demand prompts cost-cutting steps, the company has halted 23 domestic flights, which may not sound like much, but still, it's a cut, suggesting the economy is not booming, and about 9 international ones. FedEx has also reduced sorting points and consolidated loads on the ground unit, again, a sign of a slowing economy. The efforts are in line with those laid out in September when FedEx said it would reduce costs by as much as $2.7 billion in its current fiscal year. And again, here we hear that reduce cost. Again, this is something that you don't hear in a booming economy. You hear it when the economy is slowing and inflation is high. So now Amazon and FedEx both cutting along with a lot of other companies. Citing including weakness in Asia, challenges in Europe. The company withdrew its forecast for the future at the time it posted earnings. Unquestionably, the commencement and the speed and the depth of that shift. Again, listen to these key words. Unquestionably, the commencement and the speed and depth of that shift was beyond what we certainly had anticipated. That's why we've been taking down trans-Pacific flights. So again, they're showing a huge drop in demand. Well, when they're referring to trans-Pacific, what do they mean? Asia to the U.S. They're saying there's a big decline in demand. We haven't seen that show up in the economy yet, and that is a real key point that I believe we'll see in the months to come, and perhaps it'll be just as shocking as FedEx mentions. And what else is going on in the transportation industry? We see from Sea Intelligence, they report rapid ramp up in trans-Pacific blank sailings. Now, if you're wondering, what is a blank sailing? Well, think of it this way. It's when a shipment or a ship is canceled. So if you've ever been on a flight or booked to be on a flight and that flight is canceled, well, that would be a blank flight. Same terminology for when something is canceled. And that, again, not a sign of a booming economy. The number of void sailings have been ramped up drastically on the trans-Pacific, but not so much Asia to Europe. So notably, you're seeing shipments from the Asia to U.S. drop, but not to Europe, who is in desperate need due to high inflation. There have been 34 additional blank sailings on Asia, North America, West Coast, and 16 on Asia, North America, East Coast. For former, carriers have announced an extra 7 to 11 void sailings in all but 5 weeks over that period. So again, you're hearing demand is dropping off the cliff. So perhaps Bezos is indeed just being a nice guy and saying, look, what I see may not be good. Batten down those hatches because inflation is still running hot. As inflation expectations rebounded in October on record high jump in gas outlook, of course, we note in the New York Fed survey that gas prices are what consumers look at for short-term inflation expectations. But for the year ahead, they rose 5.9%, up a half percentage in September to the highest level in July. 3-year expectations also accelerated 3.1%, while the 5-year outlook rose to 2.4%. Respective increases from 2.9 and 2.2. But perhaps a shift is coming, as we saw in the news today, as wholesale prices rose 0.2% in October, less than expected, as inflation eases. So while consumers are seeing an uptick in inflation, producer prices now are starting to head lower. Perhaps that is what indeed Bezos is seeing, is say, look, instead of going and spending money today, there's going to be some deflation. Save your cash. There's not a recession. You're going to get a good deal. And if there is, you'll be glad you had it. Let's continue on. Because on a year-over-year basis, PPI, Producer Price Index, rose 8% compared to 8.4 increase in September, so clearly slowing and off the all-time peak of 11.7 hit in March. The monthly increase equals September's gain of 0.2%. Stripping out food and energy and trade services, the index rose 0.2% on the month and 5.4% on the year. Excluding just food and energy, the index was flat and up only 6.7% on the year. So you're seeing a slowdown in producer prices. But what's driving that, you might ask? Well, one key aspect, or one key commodity that is, and that's crude oil. And here you can see on this chart the Producer Price Index for final demand in blue against crude oil prices from West Texas Intermediate in red, both on a year-over-year rate of change. And you'll note the very strong relationship between these two, and with crude oil sitting at just above a 0% year-over-year change, what this implies is that indeed producer prices are going to head even lower in the months to come. And will that give the Fed reason to pause? Well, maybe not. As the number 2 person at the FOMC, Lael Brainerd says the Fed should probably soon slow the pace of rate hikes. Again, now taking the 75 basis point hike off the table as they start to downgrade. It will probably be appropriate soon to move to a slower pace of increases, but I think what's really important to emphasize, we've done a lot, but we have additional work to do, again, suggesting that in December, rate hikes, there's still going to likely be one, at least at the moment, but the pace is now slowing, and that is actually not a great sign for the economy. But if Bezos is indeed right, and you believe in him, then that means it's time to start raising cash and cut your spending. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.